Hello everyone, this is a follow-up on my previous video where I shared that the market will be choppy from mid-April till at least May when the Fed meets again. I also mentioned that the Fed could raise the interest rate by 50 basis points to combat inflation. True enough, Powell started talking about this last Thursday, and guess what? Boom! The market reversed on that day itself, and the stock market plummeted for the last 2 days, which presents some good buying opportunities for investors. So in this video, I will share some basic technical analysis of a few major stocks and areas where investors can consider buying in. Okay, before I dive into the details, quick shout out, please help me with the YouTube algorithm by clicking on the like and subscribe buttons. Your 2 clicks mean a lot to me. Okay, so what can investors expect in a week or two ahead? There are 2 possible scenarios. Firstly, most stocks are currently floating around the oversold area, so there could be a bounce soon. However, please bear in mind that bears are waiting for potential pitfalls as many tech giants are reporting their earnings this coming week. You have Apple, Google, Microsoft, Facebook, Amazon and Twitter. Any mediocre or subpar results by these big guns will likely send the market further down. To also highlight, the market is very critical and unforgiving now. I mean, you can ask Netflix, they would know. Therefore, these tech giants will have to fulfill 2 conditions to have any potential rally, and that is to beat analyst estimates and provide strong guidance for the next quarter too. In short, the various tech giants' earnings must be as good as Tesla's to have that little bit of rally. But what are the odds, man? As most of these firms are not in the massive growth stage anymore. And the issue is, Tesla didn't rally much too, as it got pulled down by the broader market. Okay, I know it seems stupid to say that market will either bounce up, which is scenario 1, or go further down, which is scenario 2. That's like stating the obvious. So for clarity, I just wanted to be honest that I cannot predict how will the market move in the next 1 to 2 weeks. But I am still of the view that the market is going to remain choppy at least till May, which means high volatility and swings. All said, the purpose of this video is to share my views on potential entry points for some of these giant companies if the market continues to slide down in the next 2 weeks. However, quick disclaimer, whatever I'm going to share are not financial advices, and sorry that I am only mainly covering stocks that I own as I watch them more closely. Okay, without further ado, here goes. Let's begin things with Tesla. Looking at the daily chart, Tesla seems to be consolidating at the range of 970 to 1110, marked by the 2 green lines, and this is likely a case of bulls fighting the bears. In other words, good delivery numbers and earnings attract buyers to step in, while the broader market is keeping the stock at range bound. If for some reasons Tesla broke below this consolidation area, the next zone is around 760 to 930. Some areas to look out for if the market continues to be bearish would be around 971 and 907, where 50 and 38.2 Fibonacci levels are. But if the stock gets dragged down by lackluster earnings of the various tech giants and hawkish Fed, anything at $800 or below is a definite buy for me. Personally, I think Tesla is going to be the most valuable company in the foreseeable future. Therefore, as the broad market keeps Tesla at this range, it is a very good opportunity for long-term investors to accumulate shares. I would think splitting the purchases into tranches would help. In other words, buy some at the top consolidation area, and if it drops further, load up more at the bottom consolidation zone. This is to ensure that you don't miss any rally to all-time high, while at the same time protect your downside. Next, let's have a look at Apple. People often say that Apple is sort of representing the economy, as it is the top holdings for many institutions and ETFs. Therefore, pay close attention to how Apple reacts and moves in the next 1 to 2 weeks. Anyway, I would like to spotlight the 200 moving average. If the broader market continues to go down, Apple will likely retest the 200 MA. Interestingly, it rebounded massively the last time it visited this moving average. The other 2 times it flirted with this moving average for a while was in March 2020 during the COVID crash and May-June period of 2021. On both occasions, it went on a monster rally after that. Therefore, personally, I think it is a good time to add a few shares at this moving average, which currently stands at around $158. To also add on, there is a support level marked by the green line at around $157. So yeah, you get it, 157 and 158 are crucial. To also highlight, there is this downward trend that is represented by the two red lines. If Apple falls below the 200 moving average and 157 support level and goes into the downward channel, the overall trend is very bearish. But just like Tesla, I think this would present a screaming buying opportunity for me, anything between 140s to sub 150. Moving on to Microsoft, as shared in my previous video, there seems to be a head and shoulder pattern forming on the weekly chart, which is a bearish signal. It is currently still in the downward channel as marked out by the two red lines and sitting on the support level of around low 270s. So if this support and neckline break, it may turn ugly because there ain't many candlesticks below it. The next significant consolidation area is marked out by the blue lines, around 195 to 220s. But I think it is quite unlikely to go into this level now as buyers would have already stepped in. Therefore, I personally feel that if you are confident about Microsoft earnings, you can step in around 270 support level and load up more if it goes below that to 260s or 250s range. Next, for Google or aka Alphabet, interestingly, the sell volume picked up over the last 3 days. Are the big boys selling? Is it somebody know something? I'm not sure. Personally, I think $2,500 has been a strong support level, which it has bounced off that level a few times, and that was the level I stepped into by last week. But now the level is breached and there is very little support below. I would think next week's earnings is very crucial. If the results are bad, we may head towards $2,100 to $2,200. But I expect $2,000 to hold. At the most, it may go down a little further to fill that gap between 1950 to around 2010. Anything below 1950 is just unimaginable and it just spells trouble. Now let's take a look at Nvidia. It didn't hold the support level of sub 200 range, and it is currently in a downward bearish trend. A look at the chart shows that there are few candlesticks below $200, and the next meaningful consolidation zone is between 115 to 155. It may sound crazy, but in this market, anything is possible. So if it goes to that range, I would think it's a really good buying opportunity. We will never know whether it will go back to that range. Personally, I had stepped in at 195 last week, as my view was that 190s to sub 200 is the demand zone where buyers may step in. I don't want to miss this area if it bounces up from here. But if this continues to go down, I will load up more at the next consolidation range or maybe support level of 180. To also highlight, Nvidia's earnings will only come in on 25th May, but investors can check out AMD's earnings to have a sensing of how did the semicon industry perform in Q1 this year. AMD's earnings is set to be released on 3rd May. Let's move on to Facebook or Meta platforms. The stock is currently testing the recent low and support level of 180. This is not good, especially when their earnings are not even reported yet. On the weekly chart, there is a bearish flag formed, representing a very bearish trend. Personally, I am not very hopeful about their upcoming earnings report, as I think it's too soon for them to solve their recent challenges. So if the results are bad, they could do a Netflix and plummet to the pandemic low at 130s range. But then, they could also do a Snapchat, where the market has probably priced in the poor results, and it may just move sideways or falls a little when the earnings are out. To be honest, this is actually one very tricky stock that I will stay on the sidelines for now until the earnings and guidance are out. Finally, let's take a look at SPY. It recently tested 50 moving average but got rejected, so it is still in the bearish trend. Both RSI and MACD are showing that there could still be a little more room to go for downside before it bounces up. To add on, it appears that there is a head and shoulder pattern formed on the weekly chart, which is a bearish sign too. But interestingly, the daily chart shows a possible inverse head and shoulder pattern, which is a bullish signal. So does this mean there could be a rally coming soon in the near term? Possible. But will it be a relief rally or a huge bounce? To be honest, I'm not sure. And to also share, head and shoulder pattern, as with other patterns, can be invalidated anytime. Also, I found a gap between 395 to 398 back in April 2021. So if the market continues to be bearish, or the big tech giants fail to meet expectations, we may head towards sub 400 to fill this gap. I also just wanted to add VIX to this part of the analysis. For those who are not aware, VIX is often used to measure the fear index. When the market panics out, VIX will go up, and vice versa. Anyway, VIX is currently sitting at 20 plus, and with the weak market sentiment, any poor results from the tech giants will send VIX up to 30s range. I believe the market is repricing itself for tighter policy by the Fed, as well as other macro factors like the war and supply chain issues. Despite the recent volatility and bloodbath, I personally think this is a good time to pick up some of the stocks I want at discounted price. Yes, at one point it may seem like you are catching a falling knife or many falling knives. That's cause nobody can time the absolute bottom. In fact, this moment could turn into a shrewd move in 5 or 10 years time. And whatever happened this year may not matter in future, as it could just be a dot on the stock chart. Sometimes you don't have to overcomplicate things, just buy into good companies when there's sale or when others are fearful. I think this method works 90% of the time. So there is no need to ponder too much over if the market will rebound from here or will it break the recent lows and dip further. It's really anyone's guess. As a long-term investor, the way to manage this is to invest in tranches, which help to catch the upside and protect the downside. Alright, that's all for this video. Are you buying the recent dips? If so, let me know in the comments section below. Lastly, thanks for watching my video. Hope you can like, share and subscribe to my channel to show a little support. Thank you.